Hello, and welcome to Portfolio Matters Share Talk. In this episode, we will be discussing the newly listed North Sea oil explorer and developer, Orcadian Energy. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, let's hear about Orcadian Energy.
A few weeks ago, we were contacted by Steve Brown, the CEO of Orcadian, who was saying the company had just been listed and they had low public awareness, and would we cover them? And we are very happy to do so. So we have gone into the company in some depth. Now, Steve Brown has very kindly fact-checked this presentation, and we have gone back and forth, but all these conclusions are our own, and he has had no input into the conclusions. So, what is Orcadian? Well, Orcadian has a series of heavy oil assets in the North Sea, and all of these assets are previous discoveries. So the oil is actually there. It's not a question of exploring for the oil. The oil was generally discovered by other oil companies going back to actually the 70s and 80s. But that period, they weren't considered economic. And so Orcadian have bought up the licenses and now plan to develop them using new technology, polymer flooding. So Orcadian Energy has current share price is at 40p, which is where it was listed. Market cap is about 25.5 million. Frankly, we don't really have financials. So Yahoo reporting that they have debt of 1.2 million. Anyway, so our conclusions are going to be that this is really interesting. We like the assets, because the oil is actually there, and according to the competent person's report, and we've run through the numbers at current oil prices, and I've used a figure of $75 for Brent, then the pilot field, which is the first one they're hoping to develop, would be very profitable. And we like the management team. But, and there is a big but. So in order to develop the pilot field, which is the first one they're hoping to develop, they would need 1.14 billion according to the CPR. Now, anyone who has watched our other podcasts on North Sea companies will know that there are a lot of these companies with assets in the North Sea that are searching for farm out partners. And the last company we covered, which was i3 Energy, has the Serenity field, which is also hoping to farm out. And that has been a real saga. And they are still trying to farm that out. And the CEO of i3 was discussing how hard it is to farm out and how difficult that market is. So although we like the company, like the management, we are cautious. And until they get the funding in place, I think this is highly speculative. Okay, so Orcadian has had a brief history on the market. It was only listed in July this year and raising 3 million at 40p. And the aim of the listing was to progress the pilot field, which they have 100% interest, towards development. So they're aiming to develop that with an FPSO, and we will get into that. Okay, so what Orcadian are planning to do is to use polymer flooding to increase the oil recovery rates on these heavy oil fields. Now, what is polymer flooding? Now, some of you who are long-term viewers of the podcast will recognize these types of charts from our work on Jersey oil and gas. And basically, they show how the oil is recovered from the rocks in a field under water flooding. So this top graphic here on the left shows the oil, which is in red, being swept through a field under a water flood. And the problem with a water flood, it tends to try and push its way through in these sort of finger formations. And once it's come through, it will follow that channel, leaving a lot of oil behind. Now, what polymer flooding does is you add a polymer to the water, which thickens the water, and then you have a stronger front to push through. And so you'll see in the bottom here, the oil is swept through much more cleanly by a polymer flood. So the blue is the water, and you have an even flooding front, and the water is being swept in front of it. And this is a chart showing an experiment using polyacrylamide, which is actually what Orcadian are planning to use as their polymer. And the top three show a sweep using just water, and you get these fingers breaking through. And once the water has broken through to the exit well, it will tend to flow through on that channel. And so you leave all this oil behind. Now, the bottom three shows a polymer flood, and you see the front is much more even. You don't get these finger formations, and you get a much better sweep. So there is oil left behind, but there's a lot less of it. And so what you do is you push down the polymer into the well, and that forms this flooding front, and then behind it you put water. So you only do the polymer as one injection, and after that you inject water. And so the water then pushes the polymer forward, and in front of the polymer is the oil. And you don't actually need very much polymer. So you're only going to put about 0.25% concentration of polymer into the water. And that's going to increase its viscosity from 1 to 25 CP, and so which is centipoise. And you'll see from this table here, that gives you a thickness of around blood. So you're not really, it's not thick, it's just making the water thicker rather than thick. And a common polymer used in polymer flooding is xanthan gum, which many of you will know from cooking. You use it as a binding and a filling agent. Okay, so it actually has quite a long history, polymer flooding. It's been used since the 60s and 70s in the US, and the biggest one was in 1996 on the 1996 on the Darking field in China, where they had 2,427 injection wells. And the reason you use polymer flooding is you increase the amount of oil recovered, and so they recovered between 6 and 12% more oil using polymer flooding than they would have done, while also cutting their water use, so the amount of water they had to inject into the field, by around 25%. And that has knock-on effects, and you then need to reprocess less water, so that cuts costs as well. And in the Courtney field in France, you had a massive increase in yield using polymer flooding, up from 5% to 30%. And there is a test done on the Captain field in the North Sea, I believe by Chevron, and it worked incredibly well. They accelerated oil production, they increased the total oil recovered, due to the polymer sweep, and they reduced the water cut and the amount of water they had to inject. So you'll see from the next chart, they started doing the test here at point C, and essentially under a water flood, they were expecting this, the dashed line. So the amount of oil they were ultimately going to get out was G. And when they did the polymer flood, they got to that ultimate oil recovery very quickly. And they then went on to produce a lot more oil. So they accelerated the point they would have got to the estimated oil recovery under water flood massively by, I think it was 6 years. They got to that point in 1.1 years instead of 7.1 years. And then they went on to produce an extra amount of oil, which is J, 1.4 million barrels. And so this was done on a small area of the Captain field as a test. And since then, the new owners of the Captain field, Ithaca, are doing a polymer flood on the entire field, I believe. Okay, so are the fields that Orcadian have suitable for a polymer flood? So if you read through the papers on polymer flooding, these are the parameters that polymer flooding is suitable for. So you have to have oil viscosity below 10,000 centipoise, temperature below 140 degrees C. Basically, if the temperature goes too high, you degrade the polymer. The permeability needs to be greater than 10 millidarcies. Essentially, if the field is too impermeable, the polymer gets stuck and won't push through. And the salinity needs to be below 200 grams a liter. And essentially, all Orcadian's fields pass with flying colors. In fact, if you look at the permeability is absolutely excellent. You're looking at permeabilities which are hundreds of times higher than the minimum, and the temperature is very, no problem at all. And the viscosity is well below the maximum. So that's all good. Okay, so let's go through Orcadian's licenses, and a reminder of the API gravity scale, and that Orcadian have heavy oil. So water has a gravity of 10, rubbing alcohol is 49, so higher is better. And Orcadian's fields are between 12 and 17, so that is defined as heavy crude oil, so it's thicker than coconut oil. And they are offshore Aberdeen, close to lots of infrastructure. So these, the bottom three areas are fields they own 100%, and then they have a 50% interest in the Finn fields, in which they're partnership with Parkmead, and Parkmead is the operator. So these are the main contract areas. Pilot is the one they want to develop first, but then they have all these others. And they have actually a couple of light oil fields, Tiberius and Bottlenose. So Pilot. So Pilot was discovered in 1989 by FINA and has been very well appraised. They've done 5 wells and 2 sidetracks. So the oil is absolutely there, but it's heavy. It's between 12 and 17. So it's got a consistency between olive oil and engine oil. And they intend to do a polymer flood. So it's discovered in 1989, and then they returned to it doing appraisal wells. And further, Pilot South was discovered in 1990, and they returned to it in 1998, so 10 years later, doing a sidetrack, but then sold it on. And it was then bought by Enquest in 2011, and then Orcadian acquired the field in 2014. So Orcadian, as a corporate entity have been going for quite a long time. They just haven't been listed this year. So they've now done a development plan in which they're intending to use 2 wellhead platforms and an FPSO. And that will cost 1.14 billion plus abandonment costs of 78 million, and envisage 4 initial wells and then 28 further wells over the 20-year life of the field. Now, Steve Brown was saying that the CPR assumes that the development cost will include a brand new floating production and support vessel, an FPSO, but that they are now investigating the possibility of cutting that by using a leased and refurbished FPSO. Okay, now I have been through the CPR calculation and I have replicated it, but putting in our own assumptions, because when the CPR was originally done, oil prices were substantially lower. So I have put in an oil price of $75 a barrel, and I have also increased initial inflation by 5%, and then additional annual inflation going forward of 1%. And I will make the spreadsheet available on our Discord for people who are interested. And if we use those numbers, if we just assume the proved oil is there, you have an NPV 8 of 223 million and an NPV 10 of 174. But things get very interesting if the probable and the possible oil is there. And then you get to actually very good numbers for a company with a market cap of 25 million. And obviously, as the oil price has risen, so our calculation comes to a much higher NPV than did the original CPR, which used lower oil prices. Okay, moving on to other assets. So the Elke and Narwhal fields, and they are south of the pilot fields, but notice how close everything is to existing infrastructure. So it should be relatively straightforward to add to existing pipelines. So Narwhal was discovered by Arco in 1993, Elke by Murphy in 2000. Both are heavy oil fields. But the oil is absolutely there. In 2003 to 2004, Petrofac bought Elke, and this negotiation was led by Steve Brown, who at that time was Petrofac's head of business development. So he has a long association with these fields and presumably has had his eye on them for some time. And Orcadian agreed to purchase Elke and Narwhal from Enquest between 2015 and 2017. So Steve Brown and Orcadian have had their eye on these fields for a long time. And these have been, because they're heavy oil, you get the impression that the other companies were essentially, they were neglected part of the portfolio. And if we do an NPV calculation on Elke and Narwhal, using the figures from the CPR, but again, increasing the oil price to $75 a barrel and increasing inflation assumptions, then you get big numbers. NPV 10 of, actually, these are the wrong way around. The NPV 10 should be 2 billion, NPV 8, 2.2 billion. But note that the CPR assumes development in 2030. So these will be further down the pipe. And I also should say that NPV calculation is just for the 3C. So proved, probable, and possible. And then we have Bowhead and Blakeney, which again are nearby. So pilot is here. These, all their fields are quite close together. And this is not yet discovered. So The first assets, they're definitely there. Bowhead, it has a 49% chance of discovery. Blakeney is proved. So Blakeney was discovered by Wintershall in 2010. It is estimated to have 90 million barrels of oil originally in place, of which 25 million are recoverable. But again, it's heavy oil. In the 70s, Mobil drilled a well which was they designated dry hole, but actually it's now considered to be a discovery, the Few field here, which is right next to Blakeney. And then the Crinan field, which is part of the Fine field here, was discovered in 1987. And that's a small field, about 27 million barrels of oil originally in place, but it's then got 20 billion cubic feet of gas. And Orcadian estimates around 3 million barrels may be recoverable. So these are small fields, but they're all close together, close to infrastructure. So incremental development may well be possible. So between 1995 and 1997, so the best part of 25 years ago, Steve Brown was involved in the purchase of Fine and Dandy by Halliburton from Monument. So he has a very long history with these fields. And then Wintershall discovered Blakeney in 2010. And the Dandy field was appraised in 98, and it flowed at over 1,000 barrels of oil per day. And finally, Finn. So Finn, these are big fields, but Orcadian only have a 50% interest in the fields, and the remainder is with Parkmead, and Parkmead are the operator. And now I own shares in Parkmead, and Parkmead is frustrating. It has been on the market for 11 years, and frankly, in that time, it has done remarkably little. It currently produces about 500 barrels of oil equivalent per day from gas fields in Holland. And waiting around for Parkmead to develop anything could be quite a frustrating experience. But these are big fields discovered by Texaco in 1978 with oil in place between 600 and 1,300 barrels. Barrels, and it's heavy oil. In fact, it's very heavy oil, API of 10. Now, that was all those charts were from the recent presentation. Then 2 weeks ago, we got an RNS from the company announcing they had farmed out the Kara prospect, which they hadn't mentioned at all in their presentation. And the Kara prospect is here, east of Dandy and south of Fine. And Carrick Resources will purchase a new 3D seismic on the field and then work it up to drill ready status. Okay, on to the competent persons report. And development plans are for using full field polymer flooding. Now, in the papers, they say that polymer flooding is most effective when used from the start. So the CPR envisages polymer flooding throughout. But they also have a couple of light oil fields we haven't talked about and are on the back burner. Those are Tiberius and Bottlenose, and those would use a water flood. And I should also mention that in order to get anything developed in the North Sea these days, you need to prove that you are developing it in an environmentally friendly, low emission fashion. And so Orcadian plan to use a single wind turbine and to electrify the rig so that the development is zero emission, and hence, so they should get approval from the Offshore Petroleum Regulator for Environment and Decommissioning, OPRED, where the CPR, so the CPR describes the assets as justified for development. And this is the table showing the resource classification for oil and gas assets. And because these have been discovered, these are reserves, but they have not been developed yet, but they're considered justified for development because they are commercial. And these are the table of reserves from the CPR. So it's got proved reserves of 58.5 million barrels and 3p of 110. And that's for the pilot field alone. When you look at their assets as a whole, you get to really very big numbers. So the best estimate, 191 million, and the highest estimate, 500 million. Okay, so who are they? Who are Orcadian? Well, this is the board, who are all white and middle-aged. So there's two ways of looking at this. There's a total lack of diversity, which is, a big thing at the moment. And the good news about this is that the team is very experienced. Steve Brown has had a long association with these fields, going back 25 years, as we have seen. So you could say that the team is the right people for the job, and they haven't hired anyone diverse because, they don't care about political correctness. They only care about getting the right people for the job. The flip side could be that they've hired only people they know, the old boys network of old middle-aged white people. But we on Portfolio Matters are very concerned about ESG, and we have a solution for their ESG problem, which is if one of them can be persuaded to put on some lippy and a skirt, they instantly become a woman. So you heard it here first.
You have to edit that out. You can't say that.
Anyway, moving swiftly on, we'll get letters.
Yeah.
This ESG stuff's easy. Stephen Brown, they've been working together for a long time. So Steve Brown founds Challenge Energy, starting with Greg Harding back in 1997 to 2002. So this is a team that have been working together with it for a long time, and clearly have had involvements with this field for an even longer period of time. And if we look at Steve Brown himself, then he is a serial entrepreneur. So you see on his CV, Exile Resources, Challenge Energy, Sintanta Energy, and now Orcadian. So Exile Resources was acquired by O&O, I think that's how you pronounce it, and was in Nigeria. It was listed on the Toronto Venture Exchange. Challenge Energy was a consultancy, actually, and that was acquired by SLR. And it had a focus on UK, Northwest Europe and Africa, and had 16 professionals. And then Sintanta Energy. Now, thank you to Steve Brown for this, but there are two Sintanta Energies, and the one we are talking about, its website no longer exists, and it was involved in oil development in Gabon, and finding this from the Wayback Machine. Now, sadly, it's not a happy story because the government of Gabon imposed on Sintanta a entrepreneur called Vincent Miclet, who was a dodgy guy, basically, and they couldn't get funding. But, if you're an entrepreneur, these things happen, particularly in Africa. And after that, Steve Brown decided to shift his focus back to more stable jurisdictions, the North Sea. Let's talk about the UK. So we still consume a lot of oil and gas, and without continued investment, then our North Sea production will continue to decline. So without further investment in gas, then the UK's domestic production would fall by 75% by 2030. And you're already seeing some of the consequences of recent lack of investment in gas, in that our production of gas has fallen by 30% this year, which is one of the causes of the current gas crunch. So we need to continue to invest in the North Sea. But obviously, the government has committed to a net zero emissions target, and they are making it difficult to invest in the North Sea. So Shell has had its Jackdaw field development plan rejected by OPRED, the Offshore Petroleum Regulator for Environment and Decommissioning, and they have not given the reasons, and that was this month. In addition, even if you get a development through the UK government and the various regulators, you face challenges from Greenpeace and the environmentalists, all of which add costs. So this month, Greenpeace were back in court battling BP over the Vorlich field and saying that the UK government was negligent in allowing the development because they failed to take into account the carbon emissions from the end use of the oil and gas. And if they were to win, that would essentially stop all oil and gas developments in the UK, but they have lost, but are appealing. So the UK oil and gas development market is difficult. The regulators and activists are imposing barriers on development, even though we still use a lot of oil and gas. And also, institutions are under a lot of pressure from activists to stop investing in oil and gas projects. And so there's a lot of less money flowing into this space, and finding farm out partners to develop new fields is difficult. So Jersey Oil and Gas are seeking 1.4 billion to develop the Greater Buchan field. And we have done a separate share talk on that. And if you are interested in Jersey Oil and Gas, I really urge you to watch that, because we are very skeptical. And then i3 Energy, which we covered a couple of weeks ago, they have had a very long and difficult history trying to get their fields in the North Sea farmed in. And they had a farm-in partner, and the market took that well, and the share price shot up. And then it turned out the farm-in partner could not demonstrate they had the money. And that was a couple of years ago. Now they have a different farm-in partner, but as of the 27th of September, they're still awaiting the partner demonstrating they had the cash. And Rockhopper have got enormous fields in the Falkland Islands, and they farmed out back in July 2012, but the field still not developed, even though Premier Oil farmed in and paid $231 million for the privilege. Those fields have never been developed. Premier have now dropped the fields, and Rockhopper now have to find another farm-in partner. So even if you find a farm-in partner, as both Rockhopper and i3 demonstrate, that's not necessarily the end of the story. This chart, which we've included in our weekly, shows that CapEx is not returning to this industry. So funding is a big problem. But the big advantage that Orcadian have is that they know that the oil is actually there. A lot of these farm-in projects, the amount of oil is under some question, whereas the Orcadian fields, they've actually had a lot of wells drilled in them, and they have a good idea of how much oil's there. So you can essentially jump straight to the financing part. All this stuff the exploration and discovery has already been done. I'm going to read these out. This is an email I received from Steve Brown discussing the financing. Financing projects is hard, and the case you have to focus on is actually the proven case. That is the only case that bankers will look at. So you have to make sure the case makes a good return. It is also important to get your source and reserve estimates audited by a good reserve auditor, and you have to have a clear idea of what your development plan is before anything can be classified as reserves. It is only reserves that will attract financing. Contingent resources won't make the cut. When you look around, there aren't that many / any AIM or London listed pre-development companies with recently audited reserves on their books. Producers have reserves, pre-production companies not so much. There are plenty of companies with resources, even more with management estimates of resources, but not so many with reserves who have had the petroleum engineering discussion / argument with their reserve auditor and been able to make a case that would stand up in court, as it were. Okay, so he's saying that actually they're in a very good position compared to other companies, but our concern is this whole industry is facing financing problems. Essentially, there really aren't many financials for this company. It's changed its name from Orcadian Energy, and the last financials were for 2020, when it was run amazingly efficiently. Admin costs were 200 grand. And total losses for the year are 230. So it's done a share placing of 3 million at 40p. Its current share price is around 40p. But note, the original aim was to raise 5 million, and it only got 3. Okay, so finally, positives. It has a good collection of assets with proven assets. We know the oil is there. It's heavy oil. So all the exploration's already been done. It has a credible development plan that uses polymer flooding. And as we have seen, polymer flooding is absolutely suitable for these fields, which have very good permeability. And actually, I really like the management. So my email exchanges with Steve Brown were very straightforward. He comes across as somebody who really has had a long involvement with these fields, and his management team in total have been together for a while, and they have also had involvement with these fields. So we like that. And also I'd like to flip that on its head in that this company's been listed for a month. Why on earth has he got in touch with this small podcast, which had, I think our last podcast had 500 views? And you'd have to say that that's somebody who's, slightly proactive and on top of his game, as demonstrated by his entrepreneurial history. Now, the cynics amongst you will be thinking, he likes being flattered by the fact this CEO has got in touch, and hence he's positive about them. And frankly, that is a danger. The other thing you may be thinking is, Keith is a Chinese capitalist and all his principles are up for sale, and Steve Brown's given him some cash. Well, the first case is absolutely true, but sadly, no offers have been forthcoming. And the assets are very valuable at current oil prices if they can be developed. And as we know, the oil price is high and rising. Now, the negatives, it's funding, frankly. CapEx is just currently not returning to this business, this industry. The industry has moved away from big CapEx projects and is concentrating on small incremental developments. And so we covered i3 Energy previously, and that is a very good example of that. It had North Sea assets it couldn't develop, so it bought these light, tight oil fields in Canada where you can just drill a new well for 3 million. And there are lots of other North Sea companies with development assets that are also competing for funding and finding it difficult to get it. And obviously these development assets, so although we know the oil's there, how the oil will flow and what the ultimate recovery rate are still subject to uncertainty. And also, the regulatory environment in the North Sea is difficult now. We've had the regulators reject the Shell's plans for the Jackdaw field, and the activists will fight you in court for all new developments. In fact, the Scottish government have been protesting to the UK government about some of the North Sea developments, which they say should never have gone ahead because of on the environmental grounds. So in summary, I like the assets, I like the management team, but do we think they're going to get funding? That is the big question. Richard, your thoughts?
Yeah, thank you very much, Keith. Very interesting. I should actually point out what Keith didn't say is that he enjoys doing these so much. He has actually been known to pay CEOs to let him do talks on their companies. And I don't know if you did in this case, Keith, did you?
No, sadly not.
I think this is really interesting, isn't it? It's a case of, I mean, all other things being equal, it's a case of a company that has value, that it's really difficult to extract that value because of the funding environment. And at the moment, we live in a world where the funding environment for businesses is generally very easy because we have very ultra low interest rates, which actually results in asset misallocation. So the question is, what point is it actually able to raise the funding for the farm out, for the development? And there are two possibilities, I guess, aren't there? One is that as the oil price goes up and up, then the returns become so attractive. But that would also require that something changes on the ESG front if these groups are going to continue to challenge every development. So, and then there is government intervention, which says, actually, we need the oil and we simply can't afford not to have it because we don't have sufficient alternative energy at the moment, which is sort of where we're heading. So you do wonder whether there's going to be some sort of crisis at some point. The floodgates will be open so that funding for these and the other ones that you mentioned, Keith, will become available. I guess that is the risk, as you say in yours, isn't it? The risk doesn't really appear to be in, are the assets there? Can they extract the oil? Is the NPV there? Yes, is the answer to all of those questions. The risk is, can they and similar good companies raise the funds to develop them? And if they can't, will they ever be able to? And when will they be able to?
Yeah, it's all down to the funding. And so what's the upside? Well, the upside is they quickly managed to find a farm out partner, in which case there are big multiples. You could see this really, the share price increasing manyfold. The downside is that it takes a long time, and during that time, the company consumes cash, and you're going to be facing multiple refinancing placings, and the share price just steadily drifts down lower. And, that is, sadly, is the fate of a lot of small oil companies.
Yeah. I guess it is one where you need to, if you're going to buy into a company of this nature, you have to be in there for the long term.
I think that's it. Thank you all for watching, and thank you for Steve Brown for getting in touch. I hope we have covered the company in all the detail he would like. I'm sorry that we couldn't come to the conclusion that we probably would like, but anyway, thank you for watching. Please can you press like and subscribe, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.